Gold just crossed $5,100 an ounce. New record. Silver, too. Both at all-time highs. And in the last 48 hours, the yen has surged more than 3%, its largest one-day gain against the dollar in nearly 6 months. Now, here's the part that should stop you cold. The New York Federal Reserve just called dealers to check dollar-yen rates. That's a precursor to intervention. And the last time the United States joined a coordinated intervention in the Japanese currency. March 2011. Right after the Fukushima earthquake. 14 years ago. Pause. This isn't a routine market fluctuation. This is a signal. And it's flashing red. Japan's Prime Minister Sanae Takaichi said on Sunday her government would take necessary steps against speculative moves. Japan's top currency diplomat confirmed close coordination with the United States. Both governments. Same direction. Same week. When you see the Bank of Japan and the US Treasury aligning to push the dollar down, that's not noise. That's a policy shift, and here's what almost nobody is connecting. This affects every dollar-denominated asset you own. Your stocks, your bonds, your savings, your purchasing power. This isn't about Japan. This is about arithmetic. By the end of this, you'll understand exactly why the math says the dollar's decline is structural, and what that means for your money in 2026 and 2027. I'm going to break this down using 3 numbers. Just 3. Each one exposes a different pressure point. Together, they create what I call a Lollapalooza, multiple forces compounding in the same direction until the outcome becomes inevitable. No politics, no ideology. Just incentives, coordination, and arithmetic. Even if you've never traded a yen in your life. This affects you directly. Let me show you why. Number 1. March 2011. The last coordinated intervention. Let's start with what just happened. On Friday, a source told Reuters that the New York Federal Reserve checked dollar-yen rates with dealers. In currency markets, rate checks are the step before action. It's the authorities saying, we're watching and we're ready to move. The yen spiked in late Asia trade. Then again in New York. Largest one-day gain in 6 months. Here's the trick most people miss. The US has not joined a coordinated effort to intervene in the yen since March 2011. Right after the Fukushima earthquake. That was a crisis response. A one-time event. This time? No earthquake. No crisis headline. Just coordination. Japan's finance minister, Satsuki Katayama, declined to comment on the rate checks, but currency diplomat Atsushi Mimura confirmed the government would maintain close coordination with the United States on foreign exchange. Dominic Bunning, head of G10FX strategy at Nomura, put it simply, if you've got both the MOF and the US Treasury looking to limit the upside in dollar-yen, that's going to be a more powerful driver. It's going to have a more powerful impact on market behavior than if it was just the MOF. That's not speculation. That's a strategist at one of Japan's largest banks telling you the rules just changed. When 2 of the world's largest economies signal they want the same thing, a weaker dollar, the market listens. Keep that detail in mind. It matters later. Number 2. 200%. Japan's debt-to-GDP ratio. Now let's look at why Japan is acting. Japan's government debt stands at more than double its economic output. Over 200% of GDP, the highest of any developed nation. And here's where the pressure compounds. A historic rise in market interest rates has raised fears for Japan's ability to service that debt. When rates go up, debt payments go up. When debt is already at 200% of GDP, even small rate increases create massive fiscal strain. Think about it like a household budget. If you owe twice your annual income and your credit card rate jumps, you don't have wiggle room. You're not cutting back on vacations. You're choosing between the mortgage and the lights. That's Japan right now. Except the mortgage is $1 trillion and the lights are public services for 125 million people. Now, the shocking part. Prime Minister Takaichi has said she will cut taxes as she campaigns for a snap election on February 8th. Read that again. Debt at 200% of GDP, interest rates rising. And the government is promising tax cuts to win an election. This is where incentives become destiny. Japan needs a weaker dollar and stronger yen to manage import costs and stabilize purchasing power. The US, under an administration threatening 100% tariffs on Canadian exports, wants competitive exports. Different reasons. Same desired outcome, weaker dollar. That's not a coincidence. That's coordination born from necessity. Number 3. 50 basis points plus 48% probability. Now let's look at the American side of the equation. The Federal Reserve meets Wednesday. Markets expect no change to interest rates. But here's what's priced in, about 50 basis points of easing for the year. That means traders are betting the Fed cuts rates twice before 2026 ends. Lower rates mean lower yields. Lower yields mean less incentive to hold dollars. Less demand for dollars means the dollar falls. But here's the twist. President Trump said Thursday he would soon announce his pick for the next Federal Reserve chair to replace Jerome Powell. On Polymarket, the leading prediction betting site, BlackRock's Rick Reeder now leads with a 48% probability. Pause. This is where most people misunderstand the story. The Fed chair controls monetary policy. Monetary policy controls interest rates. Interest rates control currency flows. If the new chair is more dovish than Powell, more inclined to cut rates, more willing to tolerate inflation, that accelerates dollar weakness. And here's what the market is pricing in. Uncertainty. Mark Chandler, chief market strategist at Bannockburn Capital Markets, said it plainly. The dollar has been fragile anyway, but the gain in the yen has been the precipitating trigger for the market to sell it across the board. There are a lot of things going on right now in the US. The protests against the latest Minnesota shooting, Trump naming the successor to Powell this week. The markets are nervous about both. Nervous markets don't hold assets denominated in uncertain currencies. They flee, and that's when everything changes. Now let's connect the three numbers. NY Fed rate checks signal coordinated intervention, first since 2011. Japan's 200% plus debt-to-GDP makes yen stabilization existential for Tokyo. 50 basis points of Fed cuts priced in, plus a potential new Fed chair, makes dollar weakness structural, not temporary. This is the Lollapalooza effect. Three forces: coordinated intervention, sovereign debt pressure, and monetary policy uncertainty, all pushing the same direction at the same time. Look at what happened Monday. Dollar index fell to a 4-month low, 97.14. Euro hit a 4-month high, $1.1854. Sterling hit a 4-month high, $1.3659. Australian dollar hit its strongest since September 2024, $0.6922. Gold broke $5,100, all-time record. Silver, all-time record. This is capital leaving the dollar, not rotating within it. Leaving. David Forrester, senior strategist at Credit Agricole, said there is potentially something larger at play here. The threat of intervention reflects a broader investor concern that Japanese and US authorities would like a weaker USD. This combined with Trump's erratic policy making, including the threat of 100% tariffs on Canadian exports if it signs a trade deal with China, is weighing on the appeal of USD assets. Now invert it. Ask, what would need to happen for this not to continue? The Fed would need to turn hawkish, but 50 basis points of cuts are priced in. Japan would need to fix its debt, but Takaichi is promising tax cuts. Coordination would need to fail, but both sides are publicly signaling alignment. None of the exit ramps are open. This isn't about conspiracy or manipulation. When incentives align across two major economies, behavior follows. That's not cynicism, that's gravity. So what does this mean for 2026 and 2027? Most likely outcome, dollar weakness continues. Fed cuts rates at least once. New Fed chair introduces additional uncertainty. Gold and hard assets outperform dollar-denominated bonds. Volatility spikes around the February 8th Japan election and any tariff announcements. Volatility is now structural. It's baked into the coordination. Here's what you do. 1. Assets. If your portfolio is 100% dollar-denominated, you're now carrying concentrated currency risk. Consider exposure to hard assets. Gold just signaled where capital is flowing. Diversification isn't about returns right now, it's about preservation. 2. Decisions. If you're holding long-term dollar bonds or fixed income instruments, understand what 50 basis points of cuts does to your real yield. Inflation-adjusted returns matter more than nominal coupons. 3. Exposure. Track Fed announcements weekly. Track yen intervention signals. Track gold as a leading indicator of dollar confidence. When gold accelerates and the dollar index breaks below 95, the next phase has begun. The math doesn't care about your politics. It doesn't care about intentions. It only cares about incentives. And incentives say the dollar weakens from here. I don't tell you what to believe. I tell you what the numbers say, and the numbers say capital is moving. The question is whether you move with it or get left behind.